Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Drew Glover, founder partner at Fiat Growth, to discuss why people invest in what they know in today's market environment. Drew, it's great to have you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
And I think it would be fair to say with retail investors, they typically invest in what they know, perhaps outside of the meme craze that we saw in 2021 and 22. But why do you think retail investors invest in what they can touch, what they can taste, products that they know, products that they use?
Well, first and foremost, historically, when you think about investing, there was a huge education gap for many, many years with the proliferation of Robinhood, Public.com, a number of these other kind of retail investment type of platforms. It's given a lot of investors the ability to kind of put their own new definition on how they want to bridge that educational gap. The easiest one, the most low-hanging fruit, is really investing in things that you can hold on to, even things you can taste. You talk about the Kava IPO, you talk about a number of these different IPOs, a lot of hardware type of businesses. These are the ones where a lot of folks that might be on the fringe or deciding if they want to lean into investing or not, those are the things that they want to lean into the most. You see a lot of retail investors investing in Apple. Like this is a phone that they can hold on to, things that they know how to operate. Think about Tesla. These are cars that you are driving. These are products that you are naturally obsessed with. So retail investors a lot of time are investing in what they know, what they can touch, what they can feel, the things that they can educate themselves on without having to necessarily go through 10, 50, 100 years of diligence in their own type of education to kind of lean into. It's a very interesting proliferation in the space that we're in today, especially as we go through the last couple years where we really had no other option but to stay inside of our homes and our apartments and engage with technology in a very intimate way.
And Drew, I would agree with you. I'm glad you brought up Apple as an example, because I feel like that has always been the proxy for retail investor interest, because you knew the product, you understood it, perhaps regardless of the valuation or some other fundamental metrics or even technical metrics on the chart. When it comes to Apple, there was always that fanboy or girl, if you will, when it comes to that particular stock. So with that said, now that access and the barriers have been brought down by all the platforms that are available these days, why is it important for the media and brands to do better when it comes to delivering education for investors?
It's a great question. And I think access to the point you just brought up is incredibly important here. It's so important in this day and age for both the media and the brands themselves to really make sure that they are educating the public the right way. At the end of the day here, these individual investors need to be able to have an opportunity to learn and to be able to engage with these products. But even more importantly, as they kind of lean into it from an investment standpoint, they need to be able to understand how they want to lean into these products.
And Drew, give us an example. Tell us more about Fiat Growth. Where do you fit in the investing ecosystem?
Yeah, so Fiat Growth is both a growth consultancy as well as a venture capital firm. So we are big believers that regardless of how many years of investment experience we have, we always need to go a little bit deeper from the diligence side. So Fiat Growth, our growth consultancy, we mainly focus on a lot of fintech companies, and we help them as an outsourced growth arm. And so we handle all their marketing, handling all their go-to-market strategy. But with all the companies that we work with, we actually get the right to invest under contract in them. So after we've worked with them for 6 months, 12 months, sometimes even 2 years, at that point, we decide if we want to actually invest in them through our investment vehicle, which is Fiat Ventures, which is a fund one, but around 60% of the investments we make are into companies that we had previously worked with on the Fiat Growth side of the business. So we're big believers that investing is changing. Folks aren't just investing because they went to a lunch with a founder and saw a very well manicured deck, but now they need to have an unfair advantage. And for us, that is really, really deep due diligence by getting to work with companies prior to actually investing capital into them.
So let's get your outlook on this as it relates to the VC side of the house and startups and so forth. This valuation reset that we saw in 2022 and the first half of 2023, in my mind, I think in a way it almost needed to happen, where to your point earlier, operational efficiency, cash flow, governance on boards, and profitability are the most important thing right now, regardless of what the pitch decks and the calm story might sound like. Valuations don't count as much as profitability and having something to show. Do you think that's going to continue as the market perhaps normalizes?
Yeah, big time. And the public market and the private markets are very cyclical. As the private markets are, going through evolution or a change or even challenges, the private markets feel it. And then when the private markets start showing a new type of kind of energy, the public markets start feeling it as well. But at the end of the day here, I think that really what we're sitting in is just back to normal. I thought, over the last decade plus, we just saw a very different market. One that was, yes, definitely exciting and thrilling, and a lot of capital was deployed. But I do think we were getting a little bit over our skis. And frankly, as an investor, I'm especially an early stage investor, I'm very, very happy with this kind of pullback. I think it also creates a very different type of energy in the private markets. There's a very different type of founder that is coming out of the woodwork now, a different type of doggedness. For someone that is going to build and start and found a company in a market like this, they're going to be ones that just have a different type of energy, have a different type of entrepreneurialism, a different type of ability to kind of like make it work by any means necessary, which is very exciting as an investor. While at the same time, I think, it will take a little bit longer for some companies to go public. I think that capital is going to be deployed a lot slower. I'd say it's much more of an investor's market than it was a founder's market a couple of years ago. A lot of founders were like, I want to start a company because I truly believe that's the quickest way to wealth for me. Where now I feel like there's a lot of founders that are starting companies because they're saying, listen, I believe there's a massive problem. I have a very unique way of solving this problem, and I'm in this for the next 15 to 20 years. And that's the type of talent that we want to invest in. So just to round that out, I believe right now as an investor, this is one of the most exciting times ever that we're going to see because as you remember, companies like Uber, companies like Airbnb, I could go down the list here, were founded in these kind of like recession type of markets. And they were the ones that came out as the most resilient brands that became the ultimate winners over the last 5 to 6 years here as they went public and really prospered coming out of that IPO.
Yeah. And Drew, you and I at the top, we kicked this off talking about the retail investor and the need for educating and so forth. But it seemed as if those, past 10, 13 years, let's call it, where there was just so much liquidity and capital available and getting, crazy valuations assigned to certain companies. By the time it got to the public market, retail investors get involved and it never even touched the IPO price after that. So I think coming into a market where the fundamentals make more sense, it is good for everyone in terms of private companies coming public and then the public investor having the opportunity.
Yeah, I mean, fundamentals are so important right now. Every decision that we're making as investors, every decision that I'm pushing founders to make in our portfolio companies, I'm saying make sure it's a revenue generating decision. We still need to be obsessed with creating really incredible experience for clients, for customers, for creating as we call it, a customer happy path, as that UI UX of any product that you touch. But we need to be thinking about revenue generating type of actions. And one thing that we weren't doing, a couple years back, and I'd say over the last decade, is we were saying, hey, let's just get as many people through the door as possible for a product. Let's get as many people at the party, and then let's figure out how to sell them drinks at a later date. That just can't be the strategy anymore. That's not how money's being deployed at every single step of the way. As we're evaluating a public company or a private company, it is really asking the question of, great, how does this go back to generating revenue? How is this diversifying the revenue channel mix that we have? But it's good because it's going back to the basics, and it's going back to call it business school economics and business school education, which is going to be awesome, I think, for the market in general, especially for the retail investor, because this shift will also help the retail investor better educate themselves on how to invest. Everyone always says, invest in what you know. So you're always going to do that. Investing in what you know is based on the education that you have at hand. And because everyone has access to invest in businesses now, we need to make sure that we're focusing on literacy and education in the space.
All right, Drew, encouraging to hear. Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.